Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinutalapati, an equity strategist for ADCB. With an objective to empower you with investment insights, on this program we discuss various perspectives shaping the global investment landscape. This week, we talk about the year-to-date performance trends and what they mean for the outlook. Let's dive straight in. It might surprise some that we are attempting to decipher the year-to-date performance of markets just less than a month into the year. But many would agree that market action was rather volatile in recent weeks, and it is important to take stock of the same. On the year-to-date basis as of January 21st, equity markets posted a loss of circa 6%. Sovereign bonds lost 1% of their value, while corporate bonds lost circa 2%. Commodities in aggregate, however, rose 6%. US dollar was rather well behaved. However, these performance trends came against a backdrop of increased volatility. Especially in the week ended January 21st, global equities suffered their biggest declines in more than a year, with the US stocks logging their biggest weekly percentage drop since the onset of the pandemic in March 2020. There were two key drivers of recent market performances. On the one hand, concerns about a potentially hawkish Fed caused a sharp rise in real rates. This, alongside still uncertain growth outlook, induced volatility into the US Treasury yield curve, which then also translated into volatility in other financial assets. On the other hand, with the Q4 2021 earnings season in progress, disappointing guidance from some corporates increased concerns about growth. This has caused a sharp derating in equities, but also raised concerns about broader weakness in the economy. This is in line with our expectations for the year, which, by the way, we described in our Outlook series on this podcast, that the key macro influence on financial markets will be the interplay between the evolution of the growth inflation mix and the corresponding policy response. Taking this into account, we laid out a base case scenario and a downside risk scenario when we discussed our 2022 outlook. Our base case scenario implied a rather stable outlook for financial markets in absence of any major external shock. Our downside risk scenario meant headwinds for most financial market assets. This latter scenario entailed the central bank policy turning inappropriate to the growth inflation mix. Any tangible rise in real rates from extremely negative levels was quoted as the risk here. In one way, we could say that the year-to-date performance trends reflect partial realization of our downside risk scenario. Looking ahead, in our view, markets are likely to fluctuate between our base case scenario and our downside risk scenario over the course of the year. Ranging from fixed income assets to equities, volatility is likely to stay elevated throughout. Yet, we still think markets are likely to spend most of their time this year in the base case scenario that we described. Clarity from the US Federal Reserve on their policy outlook, which we could get next week in their FOMC meeting, should help improve the risk pricing on the rates front. Also, with the earnings season in progress, any strong earnings reports are likely to improve the mood associated with the growth outlook. As such, in absence of a recession over the next 12 months, we believe that equity drawdowns this year are likely to remain viable. Risk assets, especially equities, are likely to get some technical support in the near term. Still weaker positioning into equities, relatively high bearish sentiment reflected in the American Association of Individual Investors survey, a sharp rise in the put-call volume ratio in the recent weeks, all point to a good amount of negativity already priced in. This could prompt the sentiment to turn positive fairly quickly if the Fed provides more clarity and positive earnings surprises come through. For equity investment opportunities, the laggards of last year are worth watching. This would include Asian markets by geography, consumer staples and healthcare by sector, clean energy, education technology and healthcare technology by theme. However, in the near term, as the concerns of the Omicron variant subside, sectors like airlines, hospitality, and consumer services could outperform quite strongly. Thank you for listening to this podcast. We hope you found it useful. It is our endeavor to provide you with timely investment insights, and we hope we can stay engaged as we navigate the investment landscape through 2022. In case you would like to get more information on what was discussed on this podcast, please reach out to your contact at ADCB. You can also log on to our website www.adcbam.com for more information. My name is Kishore Muktinutalapati, and I will be back next week with more global investment insights.